Good evening, everybody. We are very excited tonight to bring you a webinar in terms of a new deal offered by Clear Capital. Clear Capital, as introduced to you earlier, is one of our new multifamily USA-based real estate sponsors. As per our theme, it's a very high-quality institutional sponsor. And as you can see, we are joined by quite a big panel, heavy hitters within the Clear Capital team. So thank you for your time. Maybe if I can just take the time to thank you for that, to welcome you, and just maybe introduce you. Eric, I'll start with you. Eric is one of the founding partners of Clear Capital. Clear Capital's got 4 founding partners. And we are very privileged to have you, Eric. Tanya, then I'm going to jump to you. Tanya is the VP or Vice President of Capital Markets. We've got Enrique, who is the Vice President of Acquisitions. We've got Jeff McMullen, who's the Vice President of Property Operations. And then we've got Hugo Wallington, which is part of Tanya's capital market team. So Tanya, over to you, or Eric to you, just to give a brief introduction again to who's Clear Capital, what do you do, and why are you unique? Thank you.
Well, thanks, Rian. Thank you so much for having us here today and for bringing us on your platform and for taking the opportunity to introduce us to your client base. Thank you so much. We're super grateful. And before Eric starts, I definitely want to introduce Eric a little bit more. So Eric is not only one of the founding managers and partners here at Clear Capital, but Eric is also a professor. Eric teaches at the UCLA Anderson School of Management, so that's the business school at UCLA. And that's actually how I have the privilege of knowing him. He teaches multiple classes, real estate, finance, accounting, and we're privileged and have the benefit of having many of Eric's alumni on as our investors. So I will pass on the baton to Eric, and he will go over the agenda for today and talk to you in detail about Clear Capital and who we are and where we've become today. Thank you.
All right, well, next slide, please, of course. So thank you, Tanya and Rian, for those kind words and an introduction. Just really quickly, the agenda. I will give a brief overview of Clear Capital. Some of you may have seen our earlier video that we did describing our firm, but I know many of you probably were unable or have not seen that. So I'll talk a little bit about our firm, and then I'm going to pass the baton on to others. We'll walk through the particular project that we are sponsoring at present, and you can see the rest of our game plan. We'll have questions as well throughout the presentation. So we'll hopefully be able to answer any questions you might have about our firm, our strategy, the project at issue, and so forth. Next slide. Oh, this is me. And I always joke that I even at UCLA's website, I tend to have these older photos. So I'm going to keep this photo on as long as I can until perhaps my hairline absolutely demands a change. Usually my wife tells me when it's time for a pictorial change on our various platforms. But anyways, as Tanya said, I wear a couple hats. I'm one of the managing partners. And again, I live in the world of academia and empirical reality at Clear Capital, so I get to see things from multiple perspectives. But anyhow, next slide. So Clear Capital, the origins go back over 20 years now. Collectively, the partners have over 100 years in real estate in terms of experience. In the industry. At present, we have over $800 million of assets under management as we head towards $1 billion, consisting of over 4,000 multifamily units, really in California, Southwest, Sunbelt, and Mountain West areas of the United States. I'll talk to you a little bit more about that in short order. We've got almost about 400 different investors, and I guess it's one of those very flattering things for me is that after 25 years of teaching at the Anderson School and sending many MBA students out in the real world to their successes. They've come back and invested with us, which I guess is for a teacher is really a wonderful thing. Our units, as we said, are really spread out throughout the Southwest. I'll show you some more details about that in a moment. So next slide. As far as the timeline goes, I said the origins of the firm go back to the early to mid 1990s, and we really got our start doing infill projects in Los Angeles. For those of you who are familiar with the city, sort of different areas of Southern California and Los Angeles, and Echo Park, Silver Lake, West Hollywood, Hollywood areas of the city. And then obviously the one thing I always say in class is the only constant in life and in markets is change. And we've had to change along with the markets. And we started to sort of see where markets and opportunities were headed. And that was really sort of away from the coast and towards the, as I said, areas from really into Idaho, Utah, Nevada, Arizona, Texas, and so forth. And that's where we've been heading. So you can sort of see what we've been up to. And of course, the current offering here that we're talking about with you shortly in Salt Lake City, which is a market we are now very interested in and whatnot. Next slide. So here you go. This should look like a familiar picture to many of us and sort of where we've been. We just closed on one asset here in Salt Lake City and are doing a number of projects, again, as I said, in the Southwest Sunbelt and Mountain West regions of the country. And we'll be looking at other projects as we sort of expand into the Atlanta region, perhaps Tampa, Florida, as I said, sort of recognizing that there's sort of this demographic shift in the United States, which we all must pay attention to. And that is not just a short-term sort of secular trend, but something longer term and structural that is very important to sort of recognize. And so that's where our capital is heading. And I'm going to be pleased to hand the baton off to Tanya. So next slide. As I mentioned, Tanya is a former student of mine, but that's not really, doesn't give that justice. She graduated from UCLA Anderson School in 2005. She spent a number of years at Goldman Sachs in their private wealth area, interfacing with investors such as yourselves, and of course is an extraordinarily talented individual. And with that being said, Tanya, I'll pass the baton over to you.
Thanks, Eric. Thank you so much. Yes, it was a pleasure being your student, but I like working with you better. All right, so what I'm going to do is get into a little bit more detail on this opportunity that we're presenting to you today. Currently, the apartments are branded as Landing Point. We will be rebranding upon closing. This is located in Salt Lake City, Utah. So we actually are in Salt Lake as we speak, had the opportunity to view the property and are excited to be here sharing it with you. The property itself, so generally speaking, we acquire properties that are over 100 units. So this property itself has 126 specifically, with a mix of 1 bedrooms and 2 bedrooms, predominantly ones. Our projected hold period for this property, and look, the hold period in general, just it can vary. It can vary between, call it 3 to 7 years. And in this particular acquisition, we're projecting it to be more on the shorter end of the spectrum. Current average current average rent per unit at the property is around $1,000, which we've, by doing a rent survey, have seen that is below market. So hence the opportunity here for rental lift and premium, which definitely Enrique and Jeff will get into further. The going in cap rate listed right there at 4.27%, and the current occupancy is incredibly strong and has been above 95% for some time now. So very strong occupancy. What you see below is all the leverage project returns that we have identified and been able to estimate through our underwriting and our assumptions. So if all goes well as planned and we decide to sell the asset in 5 years, these are the numbers that we would hope to be able to deliver to our investors. The IRR of about 15%, cash on cash of around 6%, and the equity multiple of close to double your money in 5 years. And then
Tanya, sorry, if I can at that point, just remind our investors, our community, that they must go to the edge platforms just to see the net returns. In other words, the after-tax And after fee returns, this is, as you've mentioned, at project level.
Yes.
So I just want to remind the community of that. If you don't mind, if I can just ask you, from the documentation we've received, it seems like if this unit mix where you've said you've got 1 and 2 bedrooms, that the where 88% is 2 bedrooms and then 12% is 1 bedroom, it's quite a good mix. It's quite a desirable mix. Can you maybe provide insight into that, please?
Insight, what sort of insight, Rian? So 88% 2 bedrooms, 12% 1 bedrooms. Of those, half of them have been renovated, half are remaining to be renovated. Any other detail?
No, the question is, why do you say it's a desirable mix if it's more 2 bedrooms than 1 bedroom units?
Got it. Yes, definitely, because they can be leased for higher rents. 2 bedrooms have basically attract higher rents than 1 bedrooms. Or Eric, it seems like you definitely wanted to add something.
Well, I think that's true. I think, look, with any multifamily project, of course, it's critical that the unit mix reflect the underlying demographics of the area and neighborhood, of course. So common sense would say, let's just say you were renting to a younger demographic or students or something, you'd want smaller units, 1 bedrooms. As you sort of look at, again, a community in a market like Salt Lake City, clearly 2 bedrooms are more desirable given the local demographics. So, in fact, I would, in certain parts of this particular community, if we could find 3 bedrooms, that might even be more so, but those are very rare to find, of course, needless to say. So we're very, we find the 2 bedroom mix, that almost 90% of the 2 bedrooms here in this particular asset to be especially fitting with the local demographics and market demand.
Excellent, thank you.
Fantastic. So with that, we'll take it to the next slide. So in this slide, we walk through what essentially a return looks like to you, the investor. So if we had a 5-year hold, as we talked about in the prior page, meaning we buy in year 0 and we sell in year 5, these are our targeted expected cash flows to you, the investor. So let's start with the initial investment. Let's say you decide to invest $100,000. That's why in year 0, you see a negative 100,000. After that, you receive what's called a preferred return. The preferred return in our deals typically is 6%, and that is an annual preferred return. So you see the 6% on $100,000 in year 1 through year 5 is $6,000. We pay this preferred return quarterly, and we start the payments the first quarter after the close. After the preferred return, we return your capital to you. So you see right here, return of capital, 100,000, meaning the investment you initially made comes back to you. Now, all of this happens, the preferred return payments and the return of capital, prior to Clear Capital participating in any of the profits. And that's incredibly important in any deal you do. So please keep that in mind when you're also investing with other sponsors. So then we go into what's called the waterfall. The first level of the waterfall is when your IRR reaches between 6 and 9%. At that point in time, the split between Clear Capital and you, the investor, is 70% to you and 30% to Clear Capital. At the next level of IRR, between 9 and 12%, we have a 60-40 split. So 60% to you, the investor, and 40% Clear Capital. And finally, when we're at a level where hopefully the IRR is above 12%, there is a 50-50 split. So in total, you'll see at the bottom of this chart that the cash flow to you, the investor, hypothetically, of course, if all assumptions play out, if everything we're expecting happens, that there would be a total targeted cash flow to you of $167,000. So essentially, you gave us $100,000, we gave you $167,000. So that means from an equity multiple standpoint, you're getting 1.67 times your money, which, and if you look at it in terms of IRR, that's 11.85%. So these metrics are all to you as the investor, as opposed to the project level investor, project level IRR returns. And let's again just keep in mind what Rihan said, just about the fact that the global wealth group fee structure is not a part of these numbers. So you have to go to your individual page to see that.
Tanya, so if I can just ask a question in terms of these, let's call it projected return forecasts. At what kind of vacancy levels did Clear Capital assume in terms of calculating these projected returns?
Good question. So in our model, we assume a 5% vacancy rate going forward. And it can vary, but typically it's around that amount. And
you also speak about organic growth in rentals. And I mean, it's part of your strategy where you renovate, you reposition, there's value add. Did you work on a certain assumed annual rental growth as part of these projections as well?
We definitely did. And what I'm going to do, Rihan, is just ask Enrique, our VP of Acquisitions, to come on screen, because he can speak to the underwriting and the rental growth assumptions that have been made, definitely in more detail and specifics.
Thank you.
Thank you, Tanya. Thank you, Rihan. Great question. So I would say that generally speaking, we use a 2 to 3% top line revenue growth inflator over the 10-year period when we're running a 10-year financial model. In this particular instance, we're a little more bullish on the Salt Lake City region. So we're on the higher end of that typical. And in year 2, actually, which would be at this point, basically all of 2023, we've underwritten 4%. In this particular pocket, the projection is north of 6. So we felt comfortable doing 4% for year 2. And then the next 3 years, from years 3 to 5, will be 3% top line revenue growth, still only about 50% of what the projected rent growth is for this region.
Thank you.
Absolutely.
Okay, perfect. So we'll just go to the next slide, please. Fantastic. Now it's my turn to introduce Enrique formally. So I joined Clear Capital earlier this year, and Enrique is one of the first people after Eric that I had the chance to meet. Enrique is not only a warm and bubbly and completely fun person to work with, but he is incredibly smart. He has amazed me with his knowledge of underwriting, with his understanding of multifamily, and with his ability to multitask. So as you can see on the screen, Enrique has an incredible amount of experience, and I'm going to pass the baton to him so he can speak with you about the acquisition side of this particular asset and why we find it attractive.
Thank you, Tanya, and thank you, Rihan. Thank you, everyone, for tuning in today. It's a pleasure to be here with you. Next slide, please. I would just like to start our discussion of the Landing Point investment opportunity with really our deal sourcing capabilities. Clear Capital, as Eric mentioned, has over 20 to 25, almost 25 years actually, of experience, really through a series of predecessor companies and into the current company, Clear Capital. And that's allowed us to develop a very deep network of relationships, not only with property brokers, but also property owners, property managers, all types of vendors, lenders, et cetera. And all of these people we see as an opportunity to help source new opportunities for our platform and for our investors. So we don't just try to work with brokers or try to work with owners. There's a lot of people involved in our business here, and we look for a lead wherever we can find it. In this particular instance, we had a great relationship with a particular broker who did bring this opportunity to us, but it was 100% off market. I believe we were one of about 3 groups that he took this opportunity to. For the seller's personal reasons, he could not take it to market, and that was an opportunity we saw to find an incredible opportunity in a highly contested market. So in addition to that strong relationship with the broker, we then had a great meeting, conversations with the seller, and really just reached a verbal agreement before moving forward. And it was it was a very easy process. The gentleman was ready to sell and very happy and excited to work with a reputable investment group like Clear Capital. So from that broker relationship and that contact with the seller and really reviewing and getting through contracts very quickly, we're able to put this under contract in a timely manner and then avoid all the competition that many investors are seeing today as they're looking to acquire value-add multifamily assets across the country. Next slide, please. The next thing that I think is very important to know about Landing Point, this particular investment opportunity, and then a series of investment opportunities Clear Capital will be providing over the next several years, is why Salt Lake City? Why did we decide to move into this region and this submarket specifically? For this submarket where Landing Point Apartments is located, we've identified it to be a rapidly gentrifying submarket. The area has transformed from a historically rougher neighborhood that had an element of crime and just not a highly desirable place to live. But as the urban core of downtown has significantly increased in value, both on the for sale front and the rental rates, people have started to push into the outskirts of downtown. And this particular neighborhood is equidistant from downtown and the Salt Lake City International Airport. Around this property, which I'll go into more detail, there are significant number of buildings that are brand new construction. So there's been a lot of investment in this region, and that gave us the comfort level to understand and realize this was a good value in a rapidly changing neighborhood. And again, the rents that we have, even after our renovation, even after our organic rent growth, are going to be approximately $400 to $600 per month below the rents at the new construction properties. That's a tale as old as time. Typically, when you see that, as those new construction rents continue to climb, the older product slowly follows. And so that's our intention here. And what we also felt very strongly about is that we're buying this below replacement costs. I would say that in general, some parts of the country are an exception, but in general, it's costing about $225,000 to $250,000 per unit to build a multifamily product today. And that's something that would have to be higher density, maybe over a podium or a wrap product. So you couldn't even build what they have here today for this value. And we're buying it at a discount to that cost, which feels great in all cases. And then lastly, just as mentioned here with the rents, the submarket transforming, and just so many people moving to Salt Lake City, we've seen a trend of eroding affordability. And we feel that this workforce housing will be a beneficiary of these changes in two ways. One, for the current residents, they'll experience a greater quality of life and a greater, nicer community. And then for our investors, they will see strong returns over time as the market continues to grow and appreciate. Next slide, please.
Enrique, if I may, before you move on, can you give the community, the investors, just an indication of what is that discount, more or less? You've mentioned it in terms of the rental discount, but the discount between replacement, acquisition versus replacement, kind of what that difference, that discount is, more or less.
Absolutely. So if we assume that it would cost about, on the high end, $250,000 to build a community, and again, it wouldn't be this low density. It would have to be 4 to 5 stories, a lot tighter, more units. And then we're buying approximately $190,000 per unit. That's about a 25% discount to replacement cost today. And as everyone may know from the headlines, that cost of replacement is continuing to increase.
And if I just can have a follow-up question, it seems to me there's quite a big shortage of housing in the United States currently. So given this big demand, how did you manage to obtain the property at that kind of discount,
Yeah, a lot of it, honestly, I would love to say we had a secret sauce, but a lot of it was timing and moving quickly when the relationships we had brought the opportunity to us. And then a big piece of it was also the seller's personal situation. We find ourselves often buying from sellers that are in unique situations, whether they be financial or just personal, or really just a life event type of situation. And when we get ourselves in front of an opportunity like that, it helps us find more attractive opportunities. So a little bit of both of those factors, just acting quickly, given our reputation on those opportunities, and then the seller here needing to get out of the property, and that his loss is our gain, as they say.
Yeah, and I think just for our investors, it's a very important point. One of the, let's call it, key features of Clear Capital's process is the ability to act quickly, to execute quickly on a due diligence. And that could result, in these discounts, which then could increase the IRR and the equity multiples at the end of the period.
Absolutely. And one quick comment on that, Rian, is just to give you a little insight into how quickly we can act. Typically, when a broker, owner, or anybody really sends us an opportunity, within 24 hours, they will have a response and some feedback. And then when we are close on an opportunity, I would say that within the week, we're on site, we complete our physical due diligence in less than 48 hours, and then we can move quickly with aggressive terms, both financial and timing terms, that are attractive to sellers that say, hey, Clear Capital is a serious buyer, they're ready to make a move. And that has helped us significantly in expanding across the country.
And thanks for that. And I mean, that was also one of the things that we liked. You've got a very well-defined, repeatable process. And I think that's why you can execute.
Absolutely.
I would love just to chime in really quickly, if I could, too, if that's okay, just to show you sort of our dedication to it. There are 4 or 5 team members in Salt Lake now. I mean, we just happen to be here. So look, you can talk in theoreticals and hypotheticals and read all the secondary research articles on a particular area all you want, but you got to have boots on the ground quickly and with enough physical presence, and that's what we do, and quickly. Back to you, Enrique.
Yeah, to Eric's point, I'm probably on the fly at least twice a week. And then we have a couple of our other team members like Jeffrey McMullen and a few others that are also at least on a weekly or bi-weekly flight. So yeah, we are, we're very familiar and intimate in the neighborhoods we're buying in. Next slide, please. So in addition to why Salt Lake City in general and this submarket, I'd like to hone in specifically on the landing points location. We already dived into it a little bit, but I'd like to expand and explain why this location was the most promising and why we acted quickly on this opportunity. As you can see on this infographic, we're basically equidistant between both downtown and the Salt Lake City International Airport. The airport, which actually just underwent in the last couple of years a $4 billion renovation. They're still not finished. They're still building new concourses and terminals. So really the city is gearing up to continue to expand and serve a larger audience of people coming and going from this region. So we're very excited about that. I would say also the current resident base does consist of a good number of airport employees across not only airline related employees, but people who actually work at the airport and logistics and food service, et cetera. So we like that. And then we're in this neighborhood that's transforming. So we do have a demographic that is transitioning in some ways and also works in downtown. So if there's a household where perhaps the family is split, working in 2 separate directions, this location is very ideal. And just very high level, very easy to get to the whole Salt Lake City MSA, north, south, east, or west, because we're by 3 separate arterials, leading to over 450,000 jobs within a 10-minute drive. There's a lot of schools, both public, private, and higher education near this community. And of course, a lot of shopping and entertainment options for the residents. And when we're looking for opportunities, in addition to the jobs, I like looking for what I call sticky locations, where if a resident moves in, they can live here for several years because it's very comfortable to do so. They're close to work, they're close to their grocery store, they're close to perhaps their gym, and all the other things they like to do, like go out at night and dine and go to entertainment options, things like that. And because of that, this particular opportunity checked all those boxes. And lastly, of course, we're only about 30 to 45 minutes from all the beautiful things that Utah has to offer: skiing, snowboarding, mountain biking, hiking, fishing, and all the wildlife expeditions. So from a lifestyle perspective, this property is a great attainable housing option for many people. Next slide, please.
Enrique,
any questions, Rian?
Say that in terms of that airport, there is some construction still going. I assume
Correct.
it is an operational airport. My question is just this: let's say the construction doesn't go through as planned, and you say that there's quite a big demand from airport-related, kind of employees, what's the risk to investors in terms of a drop in demand and the impact on potential returns?
Yeah, it's a great question, Rian. I would say that we tend to shy away from communities that have a large concentration of one particular industry or employer. And while there is a number of those employees at this site, given its proximity to the airport, it does not make up more than, I believe, 20% of the rent roll. And in that instance, I mean, truly, this neighborhood is transforming rapidly. So we feel if there were to be a decline in the airport employment, that really we'd start to pull for more of the white collar professional services in the downtown region, or really also behind the airport. In addition to that $4 billion redevelopment, there's a huge influx of industrial development occurring, and that's all through the private sector. It's not necessarily city or county government sponsored like the airport would be. It's all private sector, and they're all expanding because the region has expanded. So we see some of that employment as well, and we think we could backfill those units where they go vacant with those different job profiles, residents that live and work in those different areas.
And it's our understanding as well, from, let's call it, macroeconomic factors, GDP, job growth, population growth, and so on, that Utah is above, first of all, USA averages and also above world averages, which supports multi-family assets as a real estate asset class.
Absolutely. Utah is one of those markets that really has been topping headlines and different charts for rent growth, population growth, job growth. Ease of doing business is a big factor as well. And so a lot of new companies are moving there, have been moving there, and really I feel continue to move there. Every time I fly to Salt Lake, I meet a new entrepreneur opening, expanding a new business in the region. So really, that's just anecdotal evidence, but it's really compelling, and we're really excited about it. Yeah, next slide, please. Okay, and then a quick dive into the greater economic overview of the region. Obviously, downtown has become what we call like the heartbeat of Salt Lake City. There's a lot of financial services firms, accounting firms, consulting, and other like-kind professional service providers in that region. We've seen a huge expansion in both the office and multifamily space, and this has driven a lot of people to move into these new buildings. And of course, the rents continue to rise as these higher paying jobs move into the region. And of course, this is what's causing the expansion outward into the fringes of basically downtown and giving people accessibility, but not having to pay the cost of living in downtown. And so in addition to the downtown, there's another major hub, just a couple, maybe 15 to 20 minutes southeast of downtown, called Silicon Slopes. And that's what a lot of people are familiar with today, that have a lot of tech companies such as Amazon, Adobe, Dell, eBay, some of the best public schools in the region. Some of the highest paying jobs are in this region. And while we're not immediately adjacent to that Silicon Slopes corridor, we do think that's also causing a greater growth overall. We serve the workforce housing demographic, so we may have some people that live at Landing Point and drive to the Silicon Slopes region to help service the workforce there. And then, of course, some of the things you mentioned, Rian, are highlighted here. It's ranked, the Salt Lake City economy is ranked #1 in the United States for best economy, and also ranked #1 in job creation among the nation's largest metro areas. And, just a little deeper dive into really what I like to call the fiscal discipline of the government and region, and then the ease of doing business. That $4 billion redevelopment of the airport was done on an all-cash basis with no debt or bond financing whatsoever. So that just goes to show you how fiscally conservative and responsible the government of the region is, and how they're truly growing in a strategic and very smart manner, in my opinion. And then the most important thing for us is the last bullet point. It already has the 5th largest labor force in the West, and that is projected to continue increasing by more than 17% over the next decade, compared to, as you were saying, the national average, which is just above 10%. Next slide, please. And before the next one, Rian, do you have any questions?
You're doing a very good job in positioning the fundamentals, so no, thanks.
All right, excellent. And then now, one thing we always get questions on are what are the demographics of the community and the area? So here we have really high-level area demographics, and if any of our investors would like, we do have a property-level demographic report. And if you would like to request that, our capital markets team will send that your way, and that will dive into the employers, the actual income of the property, and things like that. But from a high level, in this submarket specifically, the median income is north of $71,000. And in the Salt Lake City area in general, it's over $93,000. So when we're talking about in-place rents of $1,000, and we're still talking about moving them about $300 over a 5-year period, even above $1,300 a month, this is a very affordable housing option in the region. With median home values, which we'll talk about on the next slide, increasing and will continue to increase, it's going to make home ownership further out of reach for many people. And that allows, the alternative option like Landing Point to continue to increase its rents while still remaining an affordable option, which we feel very good about. And as you can see here in this area, within a 1-mile radius, almost 70% of the residents are renters. And that ensures, to your point about the airport and potential job losses, things like that, I think we'll find a good number of folks to backfill that with, given the nature of this neighborhood here. Next slide, please, where we'll talk about the housing values that I just mentioned. We have here the median home value per Zillow across the whole Salt Lake City area is about $437,000. A couple years ago, this was in the low 300s. So we've seen it grow significantly. And even today, I've been poking around Zillow, Redfin, a couple of the property listing websites, and there are homes in this region that match the prices of coastal markets. And the reason is, a lot of individuals are leaving these coastal markets or other big cities with less desirable quality of life, and they're moving to Utah, and that's causing a huge spike in home prices. Over the last year, home values have grown over 10%, and Zillow projects them to continue growing over the next year, north of 16%. So putting that side by side with our rent growth assumptions of about 3 to 4% per year, it feels very good that we may outperform those projections. Next slide, please.
Enrique, if I can just ask.
Absolutely.
I assume the fact that it's an established area and so on, that there's not a lot of vacant land available. So most of the enhancements or the value add should be made infill, within current properties and so on. So upcoming supply shouldn't be a risk to what we're seeing here in terms of residential multifamily.
Yeah, in our assessment of the neighborhood, this is a very mature pocket. As I mentioned, it just started transforming over the last several years. And we think we're out of the difficult phase. The last two owners have really re-tenanted the property and improved the resident profile. And now we're going to get to the phase where we can just catch up to the market because the resident profile that is now there can afford it, can absorb it. And so we feel that with the supply that's already been built, we don't see any other supply in this particular neighborhood over the next couple years. And there is a concentration of new apartments, but those are all in the downtown core, which we're still outside of that. And so in downtown, you'll find higher concessions, rents that are a little soft in some pockets. But again, it's also because their rents are significantly higher. So often to induce the resident, they'll have to offer 1 month free or something like that. But even at a 1 month free rent level, we're still below that, and we don't expect any competition. I will say one of the buildings across the street from us is still finishing construction, but their starting rents are significantly higher, and I don't think it'll have any impact on our property. Quite the opposite, actually. I think people will go to that property, say, wow, it's beautiful, but I don't want to pay, X. They'll go across the street to ours and say, well, it doesn't have all the bells and whistles like the pool and the rooftop deck and what have you, but it's the same location. The inside looks the exact same, and I can save $500 a month. So I think the opposite might happen in this case.
So if I understand you correctly, let's call it the more luxurious apartments might underpin the rental growth you're expecting.
They might what? I'm sorry?
Say the more luxurious apartments, as you said, downtown opposite, will underpin the rental growth that you're expecting.
Oh, absolutely. Absolutely. You know, these developers, I mean, to be able to build these units have to hit certain rent levels. And so they will stick to those rent levels in order to, you know, obviously support their pro forma and do the right thing for their investors. And that lifts the whole market in general. That's a trend we've seen in basically every market. Yeah.
If I may add, just,
next slide, please.
Sorry, Enrique,
Yeah,
I
go
just
ahead,
wanted to
Tanya.
add one quick thing. So yesterday, Eric, as we mentioned, we're here in Salt Lake City, and while we were visiting and speaking with some of the brokers at these various properties, you know, one main thing just about Salt Lake City when it comes to growth and expansion and construction is that there's limited space. There's a mountain range. So that's just a fact. And it's actually a very important fact when you think about investing in this region. So definitely something to keep in mind for anyone who hasn't been here and hasn't seen the fact that there's this huge mountain range, the Wasatch Mountains, and your right space is constrained. Eric, please.
No, that was an excellent point, Tanya. Actually, I hadn't thought about that. That Salt Lake City is right. It's a valley, actually. So on either side, actually, there are mountain ranges. So the sort of north-south corridor of Salt Lake City, it's constrained land-wise. So that was a great point to make, Tanya.
Excellent. You guys stole my thunder. Next slide, please. Check out what's coming.
Enrique, no one steals your thunder. Carry on.
So right before we dive into the barriers to entry in this market, we just want to touch quickly on the vacancy and rent growth. So per CoStar and also per our own rent surveys, excluding the brand new buildings that are in lease up right now, the vacancy rate for this submarket is only 4%. This property is almost 98% occupied, so we're actually performing better. And that's why we felt comfortable. I believe in the first couple of years, we're maybe at 6% vacancy, and we tapered down to 5% and stabilized there. And we feel very comfortable with that because it's already lower than we're underwriting. And then from a rent growth projection perspective, CoStar thinks that from today through the end of 2025, we will be basically above 4% every single year. And as I mentioned in our analysis, we're just assuming 4% in 2023 and then 3% thereafter. So we're very excited about the final outcome should it, you know, match the projections that CoStar has for the region. And then, of course, as you may have read, over the last decade, Utah was the fastest growing region with over 50% population growth. And that double-digit population growth is still projected to continue over the next decade. Next slide, please. All right. And so here's a little bit more into what Tanya and Eric were just discussing. You know, while Salt Lake City seems fairly flat and like you can build anywhere, it's not true. The Wasatch Mountain Range and then the Great Salt Lake on the other side of it prohibit, you know, major development. And then, of course, the state also has preserves and things like that, further limiting the supply. And then, of course, we see that, you know, because of these boundaries, this market has high barriers to entry, just like a coastal market would have. And so to be able to acquire assets in this region today, I think will be very favorable over the long term. And, you know, as I mentioned, we're buying below replacement costs. The cost of land continues to increase, so much so that, you know, in our discussions with brokers that sell land to developers of all product type, they're finding more and more developers, you know, shying away from multifamily and having to include other commercial real estate. So in essence, they can only really make mixed use offerings make sense today, and because of the land cost increases. And as mentioned, the lack of workforce housing that you just can't build, you know, our property will be a beneficiary of all these trends here. Next slide, please. And I think that about does it for me. Now I'd like to introduce to everyone Jeffrey McMullen. Jeff is our Vice President of Asset Management. He has complete oversight over our third-party property management relationships, all asset business planning and execution, and then, of course, ensuring the quality of the resident experience for all of our interstate portfolio. That portfolio consists of multifamily assets located in 5 different states. And then Jeff is a very sharp, dedicated individual who cares first and foremost about our residents, because he knows that by caring about our residents, that will take care of the property, and then that will take care of our investors. And here's Jeffrey McMullen. Thank you.
Thank you so much, Enrique, for that very kind introduction. And Rian, thank you so much for having us today. Lee, thank you as well. And welcome to all the Global Wealth investors. We're so happy to have you here today. And I'm really excited to share with you how we plan to take a landing point and change it into Aspire Salt Lake. Next slide, please. So our value add business plan consists of rebranding the property. Clear Capital produces three sort of housing products. That's Arise for our affordable products, Aspire for our workforce housing, and then Apex for our residents who choose apartment housing as a lifestyle. Landing Point is suitable for the Aspire brand. So we'll be rebranding it to Aspire Salt Lake. That rebrand process consists of four components. One, we have a strategic partnership with a property management company who shares our concern and focus on the resident experience and satisfaction. Two, we cure all critical deferred maintenance. Three, we do our exterior and common area renovations. And four, we improve the apartment homes with interior renovations. Next slide, please. And I'll go over each of those with you as they pertain to Landing Point, or what will be Aspire Salt Lake. So our strategic property management partner here in the Salt Lake area is EMG. EMG was established in 1985. They manage 5,917 units in two states. They're both in Utah and in New Mexico, another market that we are interested in pursuing. They have a proven track record for managing multifamily properties and specifically value add assets. But what we really find most compelling about EMG, and the reason why we've decided to partner with them, is that they are a mission-driven company who really emphasize best-in-class resident experience, which is incredibly important to us and important to our Aspire brand. Next slide, please. Luckily, this property's previous ownership did a really good job of maintaining the property and keeping it in really peak condition. So in this case, we have very little critical deferred maintenance that will be required. We do have some asphalt and concrete repairs that are trip hazards, which will be corrected in the first 30 days of ownership. We also have some roof damage, which has been identified. We think that we can mitigate that damage with repairs, but we have earmarked funds such that if we need to replace those roofs, we have the money available. Next slide, please. For our exterior and common area renovations, we really focus in on who is our target resident. At this property, as my colleagues have said, the unit mix is primarily 2-bedroom apartments. We have 16 1-bedroom apartments. So we see our consumer being a family primarily. That means they'll likely have a pet and they'll likely have children. So we want to make sure that the environment that we're creating for them really caters to the things that they find important and the things that they care about. So understanding our consumer is really important, and now we're just going to make sure that we build their experience around the things that are important to them. Accordingly, the first thing that we'll do is we'll rebrand it as the Aspire, as I mentioned before. One of the things that we've seen as evolve and really take off during COVID is online purchasing. People are just not going to the mom and pop store anymore or the brick and mortar. They are buying things through Amazon or other online sources. And so that means we have large packages that are coming to our properties each day, and we want to make sure that they can be managed securely. So we will be installing package lockers, and those package lockers have a revenue associated with them. We'll be upgrading the landscaping as well to make sure that the landscaping is consistent with the Aspire brand. We're going to be adding an outdoor amenity area. Currently, the property has a swimming pool, leasing office, and gym. We will be improving those spaces, but one of the things that the property lacks is an outdoor space where neighbors and families and friends could come together and barbecue, make s'mores at a fire pit. That sort of thing that really builds a community and drives a lot of value to our residents. Second, many of our residents have dogs, and currently there is no place for our residents to play with their dogs off leash, which as a dog owner myself, it's a great amenity that I enjoy almost on a weekly basis with my dogs. So I know that our residents really enjoy that too, and we'll be delivering them a dog park with a lot of the amenities that will be necessary for them to, both for their furry friends to enjoy, but also for them to enjoy. Next slide, please. For our interior renovations, the strategy here is that we are going to renovate this units that are still classics. And you'll see here some of the before and after pictures. The current ownership has done a really good job with their scope on the unit renovations, and you'll see that on the after side. That's what the 63 units that have already been renovated look like. So we're talking about stainless steel appliances in the kitchen, new cabinetry and cabinet hardware, cabinet doors. We have quartz countertops, and in some units, the previous ownership has installed washers and dryers. So we plan to continue that renovation scope. It's been very successful. And if anything, we'll just add some iterations to it if our performance exceeds our expectations and we find that we have a little bit more money available to just increase the quality of the product over and above what we've already contemplated. Next slide, please.
Jeff, before you move on,
yes, sir.
I see that in the pack we've received, let's call it, you classify the units classic, which is then these interior renovations as I understand it. And then there's some rehab units. Can you just provide clarity in terms of that rehab unit versus then the classic unit, please?
Yes, Rian, certainly. You'll see that where you see after renovation on the right-hand side of this slide, all those pictures are actually pictures of units at landing point, and that's the post-renovation units. What you see on the left side, the before renovation, that's the classic units. 63 of them are in roughly that condition. And so as those units come available, we'll be upgrading them to the renovated scope.
Okay, thank you.
Certainly. Next slide, please. The rebranding and the repositioning of the asset happens within the first 120 days of ownership. We really want to make sure that the Aspire brand is really maintained and that the quality that our residents and prospective residents come to expect from an Aspire property is there from the get-go. So that becomes our real focus for us in the first 120 days. But beyond that, we continue to add value to the property and to our residents and investors through a proactive asset management approach. And that consists of like 7 different steps along the holding period. First, as an asset manager, we have real-time and full operational transparency through our property management and asset management software platforms, so that I could go in and look at individual transactions, either payments to a vendor or payments that we've received from a particular resident, or go in and look and see about particular work orders. If someone called to say that maybe their stove wasn't working, how long did it take us to respond to that and get it fixed? So these are really important metrics that we have available to us right at our hands through these online software platforms. We also have weekly reporting and teleconferencing with our regional managers and our community managers. And this allows us to keep a real finger on the pulse of what's happening, not just for our property, but for the general submarket, and making sure that we are performing as expected, but also that if we find there are opportunities we didn't anticipate or foresee, that we're able to take advantage of those opportunities right away. We do monthly financial reporting, and that's done between our property management partners and our asset management department, just making sure that everything is on track and performing as expected. It also helps us to identify opportunities for either cost savings or for growing revenue, adding more value and increasing the NOI. We do quarterly financial reporting, and that's done not only with our asset management team, but with interdepartmentally at Clear Capital, excuse me. And then that goes out to our investors with the quarterly distributions. In addition to that, we have the biannual and ad hoc property inspections. So as an asset manager, we expect that our asset managers will be on site at least twice a year. In addition to that, and our site teams know when those visits will happen so that they could be prepared. But we also have ad hoc visits where we will go to the property unannounced because we expect that our property management partners will be ready at a moment's notice with the same level of service that the brand is committed to, no matter who is walking in the door. And then finally, we have our dynamic annual budgeting process. So when we budget annually, we are looking at each year's underwriting and comparing the performance, our anticipated performance to that underwriting to ensure that we could deliver the promises that we've made to our investors. But in addition to that, we're looking at what still can be done better than what we thought we could do before when we first underwrote the program. So even though we put a lot of time and energy into due diligence, creating the business plan for the asset, it doesn't stop there. It continues throughout the 5-year hold period. We're making sure that we're absolutely maximizing the value of the property to our residents and the returns to our investors. Next slide, please. And this is how the business plan is summarized. Essentially, over the 5-year period, we're going to be raising the average rent from the in place of $1,000 today to at least $1,318, which is an increase of $318 per month, or 31.8% over a 5-year hold period. And this is how we anticipate this will work out. The loss to lease recapture will be $82, and that's 25.79% of the targeted rent increase. Management efficiency will be about $22, and that's 6.92%. The common area improvements, $14. Many of those common area improvements are not direct revenue generators. They're indirect, so it is sometimes hard to establish what exactly is the revenue associated with them. So in this case, we have $14 that we've been able to directly assign, and that's 4.4%. And then finally, our unit renovations, where we expect to get $200 increase, which is 62.89% of our targeted rent increase of $318 over the 5-year period. So that is Landing Point, soon to be Aspire Salt Lake. Do you have any questions, Rian?
Yes, I do. If I can just understand in terms of the use of funds, there's a capital improvement budget. Is that for those initial changes, also the asphalt roof and so on and so forth?
That's correct, Rian. So we raise the capital money up front, and we deploy it immediately so that we could get the return on that investment as quickly as possible.
And then I see there's targeted or routine capex after 3 years. Can you just explain what that would typically entail and so on?
I'm sorry, Rian, could you repeat that?
Okay, my apologies. My signal not great, but I say there's a routine capex after a 3-year period, if I remember correctly. What would that routine capex entail?
Certainly. So routine CapEx would include things that would normally need to be replaced on a 3-5-year period. So those things might include new carpet, new paint, new appliances, for example, beyond what is done initially as part of the repositioning of the asset.
Thank you for that.
You're welcome.
And then, if I can just ask the funding model, if you can just go a bit into the funding model, and there is the equity raise of just over 7 million, and it's stated that Clear Capital and some of your affiliates co-invest. What's the anticipated co-investment in terms of that equity raise? If you can just comment on that, please.
I think, Rian, maybe the most appropriate person to answer this question may be Tanya or Eric.
I figured that was my cue. Typically, in all of our projects, each and every one, Clear Capital or the founding partners invest 5 to 10%. You will invariably find my name as one of the top 3 to 5 investors in any of our projects, side by side, by the way. And that's also important. When we do invest, it's pari passu, which is literally shoulder to shoulder. We are side by side with all the investors. There are no different terms for our capital than any other of our investors. So there you go.
Rian, if you don't mind,
sorry, Tanya.
Yeah, no, not at all. I just wanted to add one quick thing. It's just important for your clients to know and your investor base to know that we've been in business obviously more than 20 years and more than 335 investors. Some of those investors have actually participated on every single deal. And on average, our investors have 200,000 with us across 2 to 3 deals. Our entry point, at one point was 100,000. We lowered it to 25K so that people could get their feet wet. But what we've seen is that 25,000 has increased over time as people have had a good experience and of course, experiencing strong performance.
Thanks for that. And then also, Eric, if you can just explain, as you've said, for the first 3 years, that debt funding is done through a bridging loan. If you can just explain that mechanism to our investors, please.
Sure. So the way I always describe it, anytime you're capitalizing any venture, whether it's real estate or other business venture, it is imperative that the debt match the business plan. So given our value add strategy, invariably on any of our opportunities, we place shorter term, more flexible bridge financing on the asset. That allows us to essentially recapitalize or prepay that financing once Jeff and his crack team have execute on the strategy and place more permanent financing on the asset. It makes sense, and hopefully, I always say I hope it does intuitively, again, given the strategy to increase cash flows and value, that you wouldn't put on permanent or sort of fixed rate financing initially, because you wouldn't get the sort of funds that you would otherwise achieve once you've executed on the business plan, increase rents and cash flows. So that's what we do. Now, just to preempt a question I often get asked, which is, oh, well, gee, if you're doing sort of bridge financing and it's floating rate, aren't you taking on some interest rate risk? Which of course is an exceptionally logical and good question. In that process, we do hedge, because of course we want to make sure that we are focusing on what we can control and what we do well, and that is the business plan. If any of you can predict what the U.S. Federal Reserve will do, that would be an extraordinary gift, and I encourage you to reach out to me yesterday if you can do that. So we do hedge that risk just to make sure that if for some reason there is a spike in rates, that we're hedged on that, and that won't hopefully negative impact our cash flows or returns at all. And anyways, hopefully that answers your question, which is an incredibly important one.
And if I may ask, and if it is intellectual property, no issue at all. What does that hedge entail? Is it having an interest rate cap?
Exactly. Yeah, there's no IP there related, Rian. It's an interest rate cap that we hedge. The other thing I would add, while I'm sort of in my academics for putting that hat on and thinking about interest rate risk and all of that, what I have told investors, because we're in a very low interest rate environment, of course, globally, is that you really need to think whenever you're investing in a project, sort of if there is an increase in rates from that, and most of us don't expect that in the near term, and the U.S. Federal Reserve's already telegraphed that they're not raising rates until 2023, but I don't control what they do. To me, it's sort of the importance of being able to foresee and capture increased cash flows, and that's sort of the numerator of the value equation. And so even if we did have that increase in rates, being in the multifamily space, our value add strategy, that serves as a very effective hedge for us. And that history has proved that out for us over the last 25 years.
Is it anticipated after the 3-year period when you refinance, recapitalize, that it will be at a fixed interest rate?
Yes, that's typically what we do. So once we've executed on the plan, we have some visibility into cash flows, and we're in that sort of more sort of normative 3 to 5% increases that we expect. We put on fixed rate financing at that point, and then recapitalize. And the goal is to return a significant chunk, if not all, of the capital invested by the investors and Clear Capital, for that matter.
Yeah, and I think it is important for the investors to remember that we've got a preferred return, and as Tanya has explained, that there's only after a certain level that Clear Capital start participating. Can I just ask another question? So in terms of your model, it's a partnership model on the ground, if I can put it like that. So I understand the property management partnership. In terms of the renovations and so on, who's the partner there, and what role does Clear Capital play in that process?
So our renovations are executed with our property management partners and their preferred vendors. So as an asset manager, I work with the property management companies to implement these plans.
Okay.
There's no other party that's involved in it.
Yes, so they basically executing the plan in their role as or the plan in their role as property manager.
That's correct. If the scale of the project is larger, that we may pull in a GC or some other expert vendor, but it would be a vendor that is referred to us by the property management partner. So they're local in the market.
That makes sense. And in terms of your property manager, have you worked with them in other states, or is it a new relationship?
EMG is a newer relationship, but in fact, we just closed on another property in the Salt Lake region area with EMG, and that happened yesterday. So although it's a new relationship, it's one that we have, we're very happy about. Each and everything that they've done on our behalf, they've done with exceptional professionalism. It's been quite impressive. And so we are very bullish about this relationship and optimistic about where it may go.
Wonderful, thank you. I think that wrap up the questions from our side. And I think we're 11 minutes over time. And with the intellectual property per capita on this call, it becomes quite expensive if we run over time. So I would really like to thank the entire Clear Capital team for your transparency. I think it's one of your values as well, is transparency throughout your properties. And definitely our investors can experience that. And we would really, once again, we appreciate it. We value as a partner, and we're looking forward to multiple projects going forward, because to us, we do a lot of work initially on the due diligence, but then we would like capacity to execute on multiple deals. And I think what we've heard through the sponsor introduction, what we've heard today, I think really it's going to be a very fruitful partnership, not only between Clear Capital and the Global Wealth Group, but more importantly, to investors. So Tanya, Eric, Jeff, Enrique, Hugo, thank you very much for your time. Much appreciated. And hopefully next time we will report on a positive capital raise.
Thank you, Rian. On behalf of the whole Clear Capital team, we're honored and grateful to have the opportunity, and thanks for having us. And feel free to, of course, reach out if there are any additional questions or feedback. Of course, we'll be at the ready to answer them.
Marvelous. Thank you. We will definitely do so. So thank you, and you must have a good day.
You too.
Thank you. Bye-bye.
Bye.